Good morning, this is Money Matters, and I'm David Kroll from Mortgage Network. I'm going to talk to you for the next half hour about world events and as they relate to the economy and to money matters. My cohort, Emily Johnson from Polaris Capital, is not here today, so I'll be talking to you by myself. Okay, I'm going to first touch on the topic that Emily usually goes into in great detail, which is the markets. We've had a continued run in the bull market in equities. We're at 19,450 as of this taping, which is on Friday, December, I think it's 9th today. It looks like today is favorable for stocks again. The pre-markets are looking favorable for stocks. So it looks like the rise that began with the election is going to continue its rise. It's been a very, very, very significant rise. It's almost 1,000 points in the stock market at this point since the election. It is expected to continue through the inauguration, and there is expected to be some sort of a correction or an adjustment after the inauguration. That's not simply a Trump phenomenon. Apparently, in several of the most recent presidential elections, there's been a mini boom in the stock market from the time of election through the inauguration and usually into the first quarter, and then there's a correction. Now, why would that be? I mean, it's quite simply human speculation, optimism, the feeling that change brings better results. We also have an economy which is continuing to post incrementally better numbers. This is no different than in the many, many months before, and it's simply continued over the last month. This is not, the economy has not taken a right-angle turn with the election. The economy has instead remained exactly as it is and has incrementally shown stronger numbers. So no big changes in the economy. Big change in the stock market, in the equities market, which brings us to the next topic, which is the bond market. Now, from past shows and from your general understanding of how things work, you remember that the stock market and a rise in the stock market usually heralds a drop in the bond market. The two stocks and bonds represent opposing sides in the investment outlook. Bonds are given value because of their safety and stability and you pay for that safety and stability with relatively low yield. Stocks have credence at greater risk because they represent opportunity and growth and higher rates of return. So rates of return for stocks, depending on how much risk you want to take, are pretty much wide open. Rates of return on bonds, very, very much smaller risks, and the whole point of setting up bonds is to limit risk and to proscribe and prescribe rate of return into the future. In other words, built into the bond is a fixed rate of return. So best example of bonds is the Treasury bonds and bills, the debt of the U.S. government, which is the best that there is, the best rating, the safest that there is, because it's the full faith and credit of the U.S. government. And marching down from there, but close behind, are mortgage-backed securities, which is my stock and trade. Mortgage-backed securities are big bundles of mortgages with a bow on top and a an investment security that's structured around that big bundle of mortgages that says if you buy a share of this bundle, you will get a 4% return, or you will get a 3 3/4% return, or whatever the promise is. And indeed, you get it. Mortgage securities, Fannie Mae, Freddie Mac, FHA, VA, Ginnie Mae, mortgage securities don't default. Again, they don't default because they have in a slightly less connected fashion, but present, they have the faith and credit of the US government behind them. Out on the edges of mortgage securities, you have the mortgage securities that are floated by Wall Street, also with big packages of mortgages beneath them. And those are the mortgage securities that you'll remember brought about the big short, the collapse of the housing market in 2008 and the corresponding and simultaneous collapse in the economy overall in 2008, leading into 2009. Those mortgage securities purported to be rock solid safe with slightly higher rates of return, and it turned out that the mortgages inside those securities were not good mortgages, and the big collapse occurred. Well, what we have happening now is a dramatic collapse in the price of bonds, meaning that for a certain a bond with a $100 face value that returns 3%, an investor is not going to pay full value. He's not going to pay $100 for that bond. He's going to pay $98 or $97 for that bond, which increases the effective yield on the bond. You see how that occurs. If by paying $100 for the bond, you get $3 in annual income, then that's a 3% return. If you pay for the face value bond, for this $100 bond, if you pay $98, then in effect you are getting a 5% return, a $5 return. If you get you're not really getting, you have to do the calculation. It comes down to about a 4% return, but your yield goes up. If you pay less, your yield goes up. So bond prices, the amount that people pay for bonds, is collapsing at a serious level, and because the money's flowing into the stock market, and therefore the yields on the bonds are going up. The biggest of all bond sectors of the bond market are U.S. Treasury bills and U.S. Treasury bonds, and the queen of all U.S. Treasury bills and bonds, the single bond that is most watched and is most an indicator of market activity is the 10-year Treasury bill. Now, the 10-year Treasury is the one that also is the bellwether for the entire mortgage market. I mean, it's the one that we all watch to know where our mortgage rates are going. That yield 4 weeks ago was 1.6%. That yield, as of last night, was 2.43%. The increase is 50%. In other words, it increased 80 basis points on a value 4 weeks ago of 160 basis points, 1.6%, increase 80 basis points, 2.4. That's a 50% increase in the yield over a 4-week period, which is absolutely remarkable. This is the fastest that interest rates have increased in the bond market sector. It's the fastest that they've increased since the collapse in 2009, when there was a very radical shift in rates and yields, and this is continuing. So it's going to have some major ramifications in the economy, and In the second half of the show, I'm going to talk about those major ramifications. This is David Kroll for Money Matters. See you shortly.